In Chapter 9, Part B, we looked at the pricing of a bond issuance. In Part C, we'll look at recording bonds payable. Let's continue our example from Chapter 9, Part B. We have a $100,000 7% bond that's due in 10 years, which pays interest semi-annually. The stated rate is 7%, the market rate is also 7%, so the bonds will issue at exactly face value. To record the bond issuance, we will debit cash for the $100,000 received and credit bond payable for the $100,000 also. Subsequent to issuance, the bond will pay interest semi-annually. On June 30th, the first semi-annual interest payment will be recorded with a debit to interest expense and a credit for the cash paid. Recall that we will calculate the semi-annual cash interest payment by taking the face value multiplied by the stated rate multiplied by 1/2 because it's a semi-annual interest payment. The facts at hand: the amount is $3,500. Our accounting is complicated a little bit when bonds are issued at a discount. Recall that if the stated rate is less than the market rate, bonds will issue at a discount. The entry to record the bond issuance is as before. We will record a debit for the amount of cash proceeds received and a credit to bonds payable for the same amount. Recall, however, that at the end of the bond term, the amount that the company will have to repay is the face value. The difference between the issue price, the cash that we receive, and the amount we ultimately have to repay really represents extra interest cost. The extra amount the bond issuer will repay represents extra income to the investor. This is what induces the investor to actually buy our bond. The extra income to the investor is a cost to the issuer, and we must account for this cost. The journal entries will look something like this. We initially recorded the bond payable at $93,205, which was the issue price. Ultimately, however, we know we will have to repay the $100,000 face value. We will need to prepare an amortization schedule to increase the bond payable T account from the issue price to the face value. There are 3 steps that we will complete in order to do this. First, we'll calculate and record interest expense by taking T account carrying value multiplied by the market rate multiplied by 1/2 if it's a semi-annual interest payment. Second, we will calculate cash payment by taking face value, multiplying it by the stated rate, and again by 1/2 in the case of a semi-annual interest payment. In the case of a bond issued at a discount, carrying value and the face value will not be the same. Because they're different, the debit and credit will not equal, and we will have a difference that we must record as a credit to bond payable. This we can think of as simply being a plug in order to balance out the debits and the credits. Let's look at an example. Here's a sample amortization schedule for a bond issued at a discount. We calculated the issue price to be $93,205. On the first interest payment, we will calculate interest expense to be the carrying value multiplied by the market rate. The carrying value, notice, begins at the issue price and will change over time. Our credit for the cash payment is calculated by taking the face amount multiplied by the stated rate. Recall that the face amount was $100,000 and that the stated rate was 7%. The $100,000 multiplied by the 7% multiplied by 1/2 to reflect the semi-annual interest payment gives us the $3,500. The difference is our increase in carrying value. This is our credit to bond payable, in this case in the amount of $228 to balance our debits and our credits. Notice that the $228 increases the carrying value now to $93,433. At the date of our second semi-annual interest payment, December 31st, we go through the same steps. Our debit to interest expense is the carrying value multiplied by the market rate. Notice, however, that at this point in time we have a new carrying value. Carrying value increased to 93,433 multiplied by the market rate, which was 8%, multiplied by 1/2 for the semi-annual nature of the bond, yields 3,737. The credit is to cash in the amount of 3,500. Recall that is our face amount multiplied by our stated rate. Notice that these amounts do not change. The face amount is fixed, the stated amount is fixed per the bond. Our cash is constant over the life of the bond. The difference is a credit to our bond payable in the amount of 237, increasing our carrying value now to 93,670. We simply repeat these steps over the life of the bond until ultimately the carrying value is increased to $100,000 face value. Now let's examine the case where bonds are issued at a premium. The entry to record the bond, debit the cash proceeds received, and credit the bond payable. But in this case, the amount is greater than the amount that we will have to repay ultimately. Our amortization in this case will reflect a decline in the account value. We will record those declines with debits to the bond payable account. Let's look at an example. As before, our beginning carrying value is the issue price. This issue price is going to decline in value over time until ultimately we arrive at face value. Our first semi-annual interest payment will be a debit to interest expense and a credit to cash. The interest expense is the carrying value, 107,439, multiplied by the 6% market rate, multiplied by 1/2 for the semi-annual nature of the bond. 3,223 is our interest expense at June 30th. Our cash paid is the $100,000 face value multiplied by the 7% stated rate. In this case, to balance our debits and credits, the difference is a debit. We're going to reduce the bond payable account. At December 31st, our second semi-annual interest payment, we will simply repeat these steps, noticing that our carrying value has now changed. It is decreased from the issue price and is now only 107,162. Taking that carrying value, multiplying it by the 6% market rate, yields an interest expense of 3215. Our credit to cash does not change because the face amount is fixed at 100,000 and the stated rate is fixed at 7%. Again, we have a difference, and it is recorded as a debit to decrease our bond payable. Simply we'll repeat these steps at each of the next subsequent semi-annual interest payments, reducing our carrying value ultimately down to the face value. When we get to the end of the maturity, or perhaps even before, we will retire the bonds. A retirement of bond is the process of buying back the bond from the investors. If we wait until maturity, carrying value will equal the face amount. Our journal entry to record this retirement is straightforward. We will credit the cash and we will debit the bond payable for the face amount. It could be the case, however, that we decide to retire the debt before the scheduled maturity date. This is referred to as an early extinguishment of debt. In order to appreciate what's happening here, let's recall how a bond's market value changes as interest rates change. As rates go up, the value of a bond goes down. If the rate goes down, the value of a bond goes up. What we see is an inverse relationship between interest rates and bond prices. The entry to record a bond retirement before maturity will be to debit the bond payable equal to its carrying value at the date of retirement, and we will credit cash for the amount paid. Generally, there will be a difference. We will plug that difference with either a debit or a credit, giving us either a loss or a gain. We will report this loss or gain on the income statement, similar to other losses and gains on long-term assets and similar to revenues and expenses from our regular operations. Let's look at a specific example. Let's assume that bonds are retired 6/30/21 for a cost of $99,000. On this date, the bond's carrying value is $100,485. We'll debit bond payable for its carrying value, and we will credit cash for the $99,000 paid. In this case, our plug is going to be a credit, a gain on early extinguishment in the amount of $1,485. To understand the economics, recall the inverse relationship between market value of the bond and interest rates. It must be the case that subsequent to issuance of this bond, market rates have gone up, and thus the value of this bond has gone down. With the value having fallen, we were able to retire it at a price less than its carrying value on the books.